So we move into activity 5, the area of gift relief. Now, this is an area that is not overly complex and tends to get examined fairly regularly. And on occasion, I've seen students get very, very confused. Not all, but certainly some. So I'm hoping in this particular video, I'll be able to just open this up. Now, as you see from the title here, this particular question, activity 5, includes partial trade use. Okay, more of that in a moment. Now, we know with gift relief, yeah, it's a nice little relief. It allows individuals to gift things to perhaps family members, subject to conditions, and indeed to defer or delay the gain. It's a little bit like rollover relief in that context, okay? So in this particular question, we'll see the classic setup, where we have the conditions satisfied, and indeed we have the transfer or gift of an asset from one family member to another, and they're really asking us about the implications. So looking specifically at the requirements, we'll see calculate the chargeable gain in the tax year 23-24 and state note the future CGT cost of the freehold property to Danielle. So in essence, two parts here. Danielle is the receiver, as it were, and indeed her mother is the giver or the donor. So what about the scenario? Well, I mean, based on the requirement, I'm thinking, there's some very easy marks to have here. And we know CGT is based on subtraction. So I would have thought that in this little scenario, there's going to be, some sort of proceeds less cost equals gain in some way, even though it's a gift. Yeah. And then outside of that, there's going to be some calculation of, well, how much gift relief is in play? Because this area here is significant. This particular asset, as it were, is only been used partly for the trade. Now, we know from gift relief that one of the conditions is trade use, i.e. 100%. So therefore, I think we're going to have a calculation here where we have to restrict the gift relief. You don't get it all. If you're only using it partly, there's an issue. Okay, so we have Gerald Dean, gave her business to her daughter, 1st of January 2024. The only chargeable asset is a freehold property. That sounds fine to me, Outside of that, it was purchased a long time ago, May 99, for $100,000. So, in essence, the three-liner is going to be quite straightforward, okay? We'll see the MV in a minute. Okay, property 60% used as an office of the business and 40% let as residential accommodation. That element of it is not in play for gift relief. Then it says the freehold was valued at $350 1st of January 2024. So there's a prompt really for your MV. We don't have proceeds. What do we use? Always, 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 we use market value, okay? And again, as I said with the rollover relief question, some easy marks to be had there. Half a mark for slotting in the market value, half a mark for the cost, marks for nothing. Okay, so where do we go from here? Well, I think we're going to set up our three-liner, and then we're going to see how gift relief comes into play to really slice out part of that gain, okay? So if we look down at the answer, you'll see, and I'll do this in little bits, as it were. So first and foremost, straightforward three-liner. Every single time, nothing complicated about that, okay? Outside of that, when we move down the page, what we'll see here is, let me just move that up, apologies. Let me just move it to there. Okay, so it's the gift holder relief. We know that it's a deduction, from the gain, okay? Now, if there wasn't some element of non-trade use, then we really take all of that 250, deduct 250, bingo, chargeable gain, 0, okay? And the gain, in effect, would come into play in Daniela's comp down the line. But in this particular case, it's limited to trade use. Simple as that. There's no getting around it. It's 60%, of 250, the full gain, is eligible for gift relief. The balance is chargeable right now because you were using a residential property, okay? So moving down the page, the second part of the requirement basically said, well, what's the future base cost? So let's remember, Danielle is the receiver. Yeah, she's the receiver of the asset in relation to this gift. Okay, in terms of her base cost, well, in effect, yeah, the proceeds are 350, even though she didn't pay anything. It's the market value. We've got to deduct the held over gain, not rolled over. My apologies. The held over gain. So in effect, this 200,000 becomes her base cost. And were she to sell down the line, in effect, you would see the held over gain crystallizing, and any gain between the point of the gift and indeed the point of her disposal also coming into play. Okay? So in summary then, and this wasn't too bad and gives us a good feel, I guess, for gift relief as well. You know, in summary, not overly complicated. In one sense, I guess, made easier because there's sort of prompting on the use of gift relief. Yeah, some easy marks with the three-liner. And just to note, one of the conditions is full trade use, and that was not the case here. Okay, hope that made sense. Thanks for listening.